Welcome to day 4 of our Christmas countdown series. We've talked so far about the global economy, rates, and bonds. And today, we open the window on currencies. This year, the dollar has finally lost some altitude, in fact, quite a bit. The dollar index is off some 10% from its highs, while sterling and the euro have clearly traded solidly firmer. The big question is, does that dollar weakness just keep going? Now, the cyclical story is about rate differentials, 83 basis points against the euro and nearly 60 basis points at one stage against the pound. This has been a big factor in dollar weakness. But there is also a structural story that has gained currency. Concerns about the loss of US hegemony, large and persistent deficits, rising debt, and of course the push by many countries to diversify reserves and trade away from the dollar all feed into the de-dollarisation narrative. But it's evolution, not revolution, but a slow burn headwind for the idea of dollar dominance. Now, if all of this sounds too bearish for the dollar, contrast this with the greenback's status as the ultimate flight to safety in times of turmoil. And if global growth does disappoint more than what the market expects, the dollar's safe haven role can still reassert itself, even in a Fed cutting world. And then there is Japan, the FX wildcard. Inflation and wages are higher. Consensus expects the BOJ to finally tighten, but the yen is still trading very weak. A normalizing rates trajectory and an undervalued currency creates probably one of the most interesting upside stories in FX. So where does all of that leave us? Don't write off the dollar obituary just yet. But we also recognize the shift from how strong to how dominant and for how long. And look for selective opportunities, especially in the yen and broader currency diversification. Come back tomorrow for day 5 when we talk about yet another currency, the yellow metal. This is Sunil Garg from Kenai and Lighthouse Canton.